The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. Sorry about that. We're working on some last-minute logistics. But yes, as usual, my name is Bobby Rains. I'm here for the Investors Observer members-only workshop. So with that, let's get started. We have the same basic agenda that we always do. We're going to start with a market update, talk about what's going on at Investors Observer, and then the rest of it is member-driven content, questions, things you want to see on the website, anything like that. We got some good questions ahead of time, so I was able to put together a few slides with some bullet points or whatever in order to talk about, try to help answer those questions. But any other questions you have, you can put them in the question box. If you get questions between the workshop, mention, hey, this is a question I might like to see solved in a webinar. Obviously, you can send us an email or call us on the phone if you have a question. You don't have to wait for the workshop, but some things lend themselves to being explained in the workshop a little bit better than trying to solve a problem by email. So with that, let's get to the market update. Yeah, just mention, this is a thing for the workshop when you send those in, and we will get them, we'll prepare them. All right, so the S&P 500, this is the last year because I needed to get that old high in there. So we broke above there, and then it's not super shocking to see it come back and fill the gap. It's nice to see it bounce off of that. It looks like it might go higher from here. We'll see when we get to the what's going on in the economy section. Sort of some of the things that are driving that, but generally, right, we're sort of haven't really broken out of this trend we've been in for since the big sell-off in the spring. So generally that looks good, and it seems like the market does have a bit of a bullish bias anyway, even if it's a little bit unsettled the last couple of weeks. All right, the NASDAQ, this is 6 months because I could zoom in a little bit more because I didn't have an old high to deal with. But yeah, the NASDAQ has been the strongest of the major indices. This chart's a little less exciting because it lost a lot more ground late last and early this week. And then, so it looks like kind of it had a high at this old high here yesterday and then is below that today. So that's not super exciting. We'd like to see, see it recover and get back up above there, but we'll see what happens with that. And for Rick, I know Rick always asks about the bots covered call position. It was at a high and then has drifted back lower again. I put this chart together. We've got UUP, which is a dollar index ETF, and then bots. You can see bots went nuts back earlier in the year. But since then, it's been very much sort of inverse correlated to the dollar. Some of that's because a lot of that stuff it's got some Japanese stocks in it and also some import stuff. So there's kind of two things working there. One is just the actual currency conversion, and the other is the dollar tends to strengthen on the trade war headlines, which necessarily pushes lower high-tech products that might or would be imported. So that's that negative correlation is sort of because of two different things there. I'm hoping we'll get some progress on trade here. It seems like there's a good headline today. There's several rounds of tariffs that haven't been, there's 200 billion on China that has been essentially past the public comment period, and the administration is basically free to drop those anytime they want. And they haven't yet, which seems encouraging. And then there's another 267 billion or something like that they're talking about, but haven't really made any progress towards. So hopefully we'll get some progress there. And if we get some progress toward NAFTA, I think the dollar would probably slide a little bit and this thing would recover somewhat and we can start to, again, look for the exits. So that's my bots update. And then let's see what else is going on in the economy. Earnings season is basically over. Earnings season was good. You know, there wasn't a whole lot to worry about there. Most companies sort of beat and raised, which is what you look for. So earnings season was positive, and until a couple weeks after the third quarter ends in September, we're just dealing with sort of stragglers and off-cycle reporters as far as that goes. Trade, the market is still reacting to headlines, but the effect is shorter lived. The market turned around late this morning on a headline that the Trump administration was reaching out to China. It didn't spark a rally necessarily. It maybe stopped the slide. But yeah, the chart I had on my screen today, there was a big green candle and then a red candle that gave about 2/3 of it back, and then we kind of wandered up from there. So it's still moving markets, but it seems like it's less severe in either direction at this point, just because it seems like not a lot is actually happening on that front. So until some deal actually gets announced, I guess we're all sort of in a wait and see mode. Economic data points to continued growth. The PPI was a little bit weak today, but still basically on trend. PPI is the producer price index, so that's essentially inflation upstream from the consumer. But again, like I said, it was a little bit on trend, so it was softer than expectations, but nothing serious. And then we also got the beige book today, which is interesting. So the beige book is the Federal Reserve and the various Federal Reserve banks basically conduct surveys in the 12 Federal Reserve districts and sort of compile a collection of anecdotes and reports from businesses about what's going on in the economy. So that's always kind of an interesting read. People will do data analysis of like, oh, they mentioned the word trade this many times this month and only this many times last month and things like that. And I don't know, it gives you a sense of what people are worried about at least. But the things that I thought were interesting were these. I pulled out a couple quotes. Businesses generally remain optimistic about the near-term outlook, concern and uncertainty about trade, particularly but not only among manufacturers. It seems like retailers would probably also be at least a little concerned about trade. That's my guess anyway, as though what that particularly but not only means. And then, yes, some businesses had to scale back or postpone capital investment. That's never good. You like to see people being able to get on with their lives and do what they need to do and not wait for some regulatory or change like that. And then these other pieces are interesting to me. Labor markets continue to be characterized as tight throughout the country, with most districts reporting widespread shortages. The unemployment rate has been low and lower and has continued to sort of surpass people's expectations in terms of how low it can go, which I think generally means there are people who are not in the labor market who are coming in and finding jobs basically when they return to the labor market, as opposed to joining the pool of unemployed and then finding jobs, which would cause the actual unemployment rate to maybe remain steadier. That's how I read that in any case. But then, so we have tight labor markets, widespread shortages of workers, but wage growth is only modest or moderate, steep wage hikes for construction workers. Businesses were using benefits, vacation time, flexible schedules, bonuses to attract and retain workers, as well as putting more resources into training. I mean, it's high school level economics to know that, like, if the supply of something gets short, the price of that something should get higher. And yet we have severe labor shortage and wage growth is modest to moderate. So that seems like a little bit of an imbalance there. And then all of these other things, benefits, vacation time, flexible schedules, bonuses, seems like things to try not to have to raise wages. Obviously, from the business end, raising wages leads to lower margins in most cases, unless you can pass those costs on to the consumer. From the worker end, higher wages are probably better. From an overall economy standpoint, higher wages are probably generally better over the longer term, as opposed to having super low wages. But yeah, we'll see how that plays out. It's been It's been an interesting development. Wage growth has started to accelerate a little bit, but it's still well below where everybody sort of thinks it should be. But it's been interesting to watch the sort of labor market and wages in particular recover since the recession. All right, so before we get to the next slide, I'm going to turn things over to Rob Silverman, who's our member success coordinator, and he is going to tell you about an exciting thing happening that is new at Investors Observer. So I'm going to turn things over to Rob here.
Alrighty, hey there everyone. I just wanted to let you know about a beta program that we're going to be launching here soon. We are hard at work on some exciting new features for the Investors Observer website, and part of that is going to be a beta process of both working out bugs as well as soliciting feedback from our members. And since those of you who are attending this webinar are some of our most engaged members, we wanted to get you in on the process a little bit early. This beta isn't going to be happening for another 6 to 8 weeks is what it's looking like right now, but we kind of wanted to give you guys the first crack at signing up for this. So Bobby is throwing my email address in the chat portion of the GoToWebinar interface here. You can see it there. It's rsilverman@freshbrewmedia.com. You can also email us at support@investorsobserver.com. And if you just write us in really quickly and say that you're interested in being part of this beta, testing out some of our new features and giving us some feedback, we would be thrilled to have you, and we'll put you on the short list for it. So feel free to reach out, and we'll be excited to hear from you in the near future here. I'll also make sure to add another reminder about this at the next webinar in 3 weeks, so you'll have another opportunity to put your name in the hat before the beta program starts. And that's about what I've got. Thanks, guys.
All right, thanks, Rob. All right, so let's get to the subscriber questions. We got a bunch this week, or yeah, we got a bunch this time. This 3 weeks, fortnight and a half. I don't know what the, yeah, I don't know how to refer to a 3-week period. That seems like there should be a word for that. In any case, we got a bunch. Thank you to everybody who submitted questions. You know, anyone else who has questions, please put them in the box here today, or, you know, if it's something you want to see on slides, throw it to me before the next time. All right, let's go. So from Bob, he said, it appears to me that with covered calls, you can collect more premium in total if you sell a series of out-of-the-money weekly options versus one monthly option, assuming the stock has weekly options. Your comments. So, I mean, basically, Rob is correct, or yeah, Bob is correct. All things being equal, 4 1-week calls at the same strike will have a higher premium than 1 4-week call at the same at that strike. Right now, where that gets tricky is commissions. Depending on where you're trading, you're going to be paying roughly 4 times the fees, and while the premium for 4 calls will be higher, it won't be 4 times higher. So you kind of have to do that math a little bit to see which one works out better. Now, the trade idea generator algorithms have a cash minimum. So, you know, I mean, you can get a very high annualized return selling calls on Thursday that expire on Friday, but your chances of making any money actually after commissions are pretty low because the cash amount of the premium you're getting on that 1-day call is not going to be super high. And so we do have a cash minimum baked into the algorithms to try to protect you from that. But generally after that, yeah, we are sort of trying to look for highest annualized return. So, you know, that's why you'll see things that are different in different time periods. In terms of expiration, we don't all have the same time period expiration because we are trying to hit that cash minimum and then also sort of solve for highest annualized return and a few other things. So that's how we handle that. Obviously, you know, if you have a situation where you're paying very, very low or no commissions, you know, something like that, then your mileage on that will be a little bit different. We may look at trying to do a different algorithm for people who have different commission structures in the future, but for now, that's kind of what we came up with. But yeah, the basic thesis here, Bob, is 100% correct. Like 4 1-week calls will definitely pay you more than 1 4-week call, and that's just because of the premium curve expires in a it's a curve, not a straight line, and so yeah, that's why that works the way it does. All right, next we had a whole bunch of questions about a couple different spread trading questions, actually. All right, so defending a credit spread. I didn't bring my sheet in here that had the actual question, but the gist of it was, how do you defend the credit spread as it starts to go bad as you get closer to expiration? And the answer is mostly to roll it. Unfortunately, unlike the covered call or diagonal spread where you only roll one leg, in a vertical spread you roll both legs, right? Because they both expire at the same time. So that means basically closing the position for a loss and then opening a new position in the same stock. The best case seems to me that you have basically the same position that should be at the same credit, and you're hoping for the stock to rise. So basically you've just turned a losing trade that's expiring soon into a losing trade that's expiring further out and hoping the stock will go up. And that's, I mean, maybe a strategy depending on the circumstance. It's certainly not turning a loser into a winner, though. It's really seems more like living to fight another day, which there's nothing wrong with that. That's fine. Typically, my position is, and what we do here in our portfolios is, try to manage losses as best we can by just closing things. And rather than close a trade on a stock that just went against us and then opening a new trade on the same stock, I would much rather close a trade and then open a new position on a different stock. Yeah, more likely what I've seen when you roll credit spreads is you end up either paying in or widening the spread. In both cases, you're putting more at risk against a stock that just went against you, which, again, in cases where maybe the whole market went down and it dragged your stock down with it, those kinds of things. There's some individual cases where I think this is probably fine. But as a general rule, if I was just wrong about something, doubling down on it is not necessarily my favorite strategy. So that's kind of how I feel about that. And yeah, all right, so early assignment. So all of this is said with the caveat that with American style options, which is essentially all options we trade here, I think the index options, things that are cash settled, tend to not be American style. American style just means they can be assigned ahead of expiration. The other option is European style, which is only assigned at expiration. But yeah, with American style options, early assignment is potentially possible at any time. So theoretically, if the person on the other side of your trade accidentally pushes the exercise option button, you can be assigned. That's pretty unpredictable. There have been 1 or 2 cases in the years that I've been doing this across easily hundreds of positions, maybe into the thousands. I'm not even sure how many we've done at this point. That I've been doing this where there's been an early assignment that was completely unexpected and I have no idea why it happens. And then it's usually like 1 or 2 contracts, and again, I have no idea what happens. So, caveat, anytime you sell an option, it can be assigned at the whim of the buyer. And so, right, everything else, like, it's relatively rare, but it is possible. So everything that comes after this is with the caveat that it can happen at any time for any reason. All right, so typically options are only assigned on ex-dividend dates. Typically it'll be like the morning before you'll get an email that says, oh, your option was assigned. Even though not all ex-dividend dates are the same. the cash value of the dividend must be greater than the extrinsic value of the option. This means that deep in the money options and short dated options are most likely to be at risk of assignment, right? I mean, if you think about it, deep in the money options and short dated options are the ones that have the lowest extrinsic value. So those are the cases where it's most likely that the cash amount of the dividend will be higher than the extrinsic value. All right, so let's talk about this for a second before we move on. So the reason this makes sense, the reason you exercise an option, the other way to close an option position is to sell it, right? If you buy an option, you could sell it as opposed to exercising. And if there's a lot of extrinsic value, if you exercise it, you can realize the intrinsic value and the extrinsic value disappears. I mean, if I had something that was worth $1.50 and I could exercise it for $1, it doesn't make sense to exercise it for $1 if I could sell it for $1.50. Right? Unless I can exercise it for $1 and then get 60 cents in dividend. That makes sense. Okay, so that's why early assignment is relatively rare, is because you can sell back the extrinsic value to the market. And so the only time you really see early assignment is, again, short dated, deep in the money options, in cases where like maybe the bid-ask spread makes it so you can't really sell any extrinsic value back to the market. That's really the only time that it makes sense. Again, right, people can push that exercise button in their brokerage account for whenever it strikes their fancy, but that's really the only time I've seen it happen. Now, options you own, so any option position you bought can only be exercised by you. That right, there's no risk of early exercise or assignment on long options. And puts cover the sale of a stock. So the buyer of a put has the option to sell the stock. So exercising a put before an ex-dividend date, for example, would essentially cost the put buyer the dividend. There's no reason to there's no dividend liability on either side of a put trade. So there's no real risk of early exercise with puts. Again, right, like things get very deep in the money, things are extremely short dated. You can see things get exercised early, but it doesn't happen super often. And yeah, again, early exercise only ever makes sense if the extrinsic value is very low, because otherwise, why wouldn't you just sell the extrinsic value? You're just making money evaporate if you're exercising. If you're exercising options early, if they still have extrinsic value. All right, so I do have a little bit of a checklist. Sometimes in covered calls, particularly in diagonal spreads, in diagonal spreads, we really try to avoid the early assignment on ex-dividend dates. Some people prefer to do it in covered calls. So there's sort of a checklist you can go through, right? Is your sold call in the money? If it's not, you got no problems, right? Nobody's exercising out of the money options. If yes, is the dividend payment greater than the extrinsic value? If not, no problem, right? Nobody's going to give up 50 cents in extrinsic value to collect the 25-cent dividend. If it is, though, and you don't want to be assigned, then you have to do something. Your options are close the trade, right? You sell the bought leg, buy the sold leg for ideally something approximating the width of the strike width. If not, take something less to avoid, because if you get assigned on a diagonal spread in particular, if you get assigned early on a covered call, what happens is your position just closes for whatever the net debit was, right? Your profit is going to be the strike price minus whatever your net debit was. So you're not really out anything. You don't collect the dividend, but whatever. In a diagonal spread, you end up owing the dividend because you're short the stock after your sold call is assigned, but you don't collect it from anywhere. So now you have to pay exercise and assignment fees, and you also owe the dividend. And so that's kind of ugly. So that's why we try to work around that. And so your options are essentially close the trade, or if you don't want to close the trade, you can just roll the sold leg out to a new leg that is either out of the money or has a higher extrinsic value than the cash amount of the dividend. most dividends aren't that big these days. At Disney, I think, used to pay an annual dividend in December, and that one was really hard to roll around because it was more than $1, I think, on a stock that was less than $100 at the time. But yeah, I mean, a lot of these dividends now aren't super hard. You roll out a month or a couple weeks, and it's not super hard to get around that. All right, so more questions. Any questions on this or anything else? Go ahead, put them in the box and we'll get to them. So Rick says, IO is recommending shorter duration verticals, 10 to 14 days. Is there any particular reason? Let's go to the website here. Also go back to the open trades. So we've we've varied up the durations a little bit. This one we put out earlier this week is exactly 10 days. We put out one, target was almost a month. We sort of, we're trying to sort of vary the durations. It seems like another kind of diversification, in a sense, in terms of, you can get more stocks if you try to, right, like Target, I couldn't make work for a 7-day vertical. And we our analysts have had a sort of ongoing discussion about, we definitely had when we put out the IWM, we had some options that were shorter and some options that were longer. And we kind of liked the IWM one because we had one that was shorter than that actually. But given that we don't know what the headline risk is, we decided we didn't really want to do a 7-day trade. We'd rather do the week and a half, 10-day trade, just because 10 days essentially gives us longer to recover from a headline we don't like. And certainly with Target, a month certainly gives you a chance for more bad headlines, but it also gives you more chance for things to recover. And since we generally think the market has an upward bias right now, more time for things to go up seems better. So we're sort of varying the durations to do that. I know we have done a lot that were pretty short, but it's just sort of been the trades we liked more than any particular more than any particular reason. Like we may go back to the longer ones. We may keep doing the shorter ones. It really just depends on what else we can find. We're less married to duration than we are the sort of underlying analysis about do we think this is going to work? Is this a name we like? Do we like the setup in terms of where there's some support and resistance and things like that? Those things actually matter to us more than the actual number of days. And then let's see, Rick also had a question about PPC, which I'm not 100% sure what exactly it is you were looking for there, Rick, but we can take a look at the chart, etc. Yeah, that's pretty ugly. Yeah, it's lost a lot of ground, that is for sure. PPC is about, right, mostly a chicken concern. So I know there's been some, there is some trade risk with some of the meat producers. I don't know how much Pilgrim's Pride is impacted by that off the top of my head. I know there are some parts of chickens that aren't particularly popular to eat in the United States that were getting exported to China for a while. And China has hit a lot of agricultural goods. I don't know if chicken parts is one of them, but my guess is it's probably on the list somewhere. And yeah, we don't have, we only had the 2 option strategies on the covered call and short put, so it's yeah, these low dollar stocks, it's harder to put diagonal spreads together on in particular, but sometimes vertical spreads don't work as well either. It gets a, yeah, let's go over to stock score report and look at that in more detail. That's a pretty ugly stock score report also. Yeah, so Wall Street's not super down on it. Has a moderate buy, average recommendation, and the median analyst estimate is for it to go up. That PE ratio is pretty low, but my guess is their earnings growth is pretty weak. And so that would explain the low fundamental score there. And then, yeah, the technical score is just about the stock losing, oh, not quite 50% of its value in the last, yeah, since December. That's what that's about. And then, yeah, it's a little bit jagged also. You know, we like to see things that are in more of a sort of a straight line. But yeah, also just losing ground in a hurry will cost you quite a bit on the technicals. And these big moves up or down on the shorter term chart aren't very attractive either. We try to look for things that are more consistent, closer to sort of a ruler thing to give them higher technical scores. All right, yeah. Any other questions that anyone has? Or Rick, if there's something in particular about PPC that I didn't get to there, let me know. Yeah, anything that we've got, yeah, anything else you want to know? We are here to answer it. Yeah, I don't know exactly what kind of trades you're looking at on gold, Rick. I don't love gold personally. It's fine as a, yeah, it makes nice jewelry. Is I guess the nicest thing I can say about it. This is the gold ETF, which is less noisy than maybe the actual price of gold has been recently. But yeah, it's not, it seems like a fine trade, but it's a commodity, right? It's cyclical. It doesn't seem like it's doing a lot in, you know, in terms here of providing a hedge against anything. It doesn't have earnings. It doesn't pay a dividend. I don't, yeah, I don't love it. Certainly if you wanted to try to do some technical analysis and find it at a low and ride it to the top, you can do that. GG, I think, is a miner. Yeah, so the miners tend to be a little bit more volatile than the underlying commodity. I think GDX is a ETF of miners. Yeah. And then I think if you want to get really volatile, you can go with something like the GDXJ, which is essentially smaller gold mining companies. It looks a lot like the GDX, the chart does, but it tends to be more volatile. So if you want to try to make that sort of swing work for you, you know, something like that might be the way to go. Yeah, the sort of internals of the individual gold mining companies it's a lot like oil companies, right? And even then, right, like trading Exxon or Chevron is one thing, whereas trading a, you know, like a pure play some little fracking company, trying to figure out the individual costs of that, or because you got to figure out what the break even is and then compare it to the price. And then, some of these super local guys have extremely specific break evens and they're not the same. You can't compare it to the futures contract price because they have exorbitant shipping costs and can't actually sell it at that. So I generally try to stay away from these just because they don't trade on things that I understand or am interested in. I'm not super interested in being a commodities trader, so I just kind of stay away. But yeah, it is, again, I mean, you can zoom out to 5 years here and you see that it goes up and down and then up and then down, which, right, certainly you could probably look at, I mean, with any sort of commodity thing, you look at the recent price action and see who's cutting back. And then when, the price gets real high and people start cutting back, that's probably when it's going to start to fall. And then the price gets real low and people start ramping up production. It's kind of when it goes the other way. Obviously, the production and price aren't exactly lined up, but typically what happens is the price goes down, people start, trying to produce as much gold as they can. Or no, sorry, the price goes up, people start trying to produce a lot of gold, and then the price starts to fall. People, right, the price falls below your break-even price of production, and you cut back on production, that dries up the supply, and the whole cycle repeats itself again. That's basically every commodity story. That's why you have oil boom and busts and things like that. That's why we're seeing what we're seeing now with MU in the flash memory space. Flash memory is basically a commodity, right? Like one company's flash memory is the same as another's, whereas AMD or Intel or NVIDIA, they make some pieces that can do similar things, but an AMD chip is not a one-to-one replacement for an NVIDIA chip. Whereas, yeah, flash memory, everybody just tries to pump out as much as they can when the price is high, and you get some overproduction and the price falls. And it's that's the commodity story, and it's as old as time. Farming, oil, all of them. That's basically how it works. Uh, 5G. I'm not 100% sure what you mean by the 5G plays. I mean, if you mean the wireless, yeah, wireless carriers are a whole different deal, right? Like Verizon, or something like that, or maybe, yeah, those guys are very different. I mean, Verizon's a telecom, right? Verizon owns like Yahoo and all kinds of weird stuff now. And AT&T is similar. And Verizon's come back some, but it's not where it was. Yeah, maybe it is. Yeah, Verizon's come back quite a bit. AT&T is probably not too far behind because they tend to travel the same. All these guys are a little bit different now because they're all trying to figure things out. AT&T owns the Dish network. Yeah, so AT&T looks very different from Verizon. AT&T owns the Dish network now. Verizon owns a bunch of like weird internet media things that I think the Huffington Post and Yahoo and some old AOL assets. That's all wrapped up in something they call Oath now. And then you've got T-Mobile and Sprint, which are trying to merge. And the review of that, I think, got put on hold today, which probably sent the stock. No, did not send the stock down. Sent it up. Okay. So yeah, that's a thing. Yeah. Right. All of these charts look different, which is kind of interesting. So I think these are sort of different. Yeah, these have a lot to do with what you think their infrastructure costs are going to be versus what you think they can sell the service for, and some things like that. And I don't mind these guys, but typically they're all, their earnings are pretty similar, and then in terms of the trends at least, then they all have some weird internal stuff, but I don't think cell phones are going away. I think 5G is going to be a thing. I don't have any sense of whether or not one of the wireless carriers is stronger than another one. Nor do I really have a good sense of whether or not people will switch. I know where I live, which is kind of suburban. The reception is different on different carriers. If you live in a big city, it certainly seems like all the carriers are interchangeable, so you just go on price. But that coverage map is pretty important depending on where you live. So, right, my cell service provider is very much based on where I live and is less about price. It's about who can deliver the service to me. So that kind of stuff is a little bit hard to figure out. But yeah, I don't think they're going anywhere, and they certainly don't have the even though it seems like it should be a commodity, they don't have quite the same commodity cycle that you see with the other stuff we were just talking about. All right, so Thomas asks about this IWM position. So yeah, IWM is down 43 cents today. It was down yesterday. I guess it was up a little bit yesterday, but down the day before. In any case, we feel like IWM has some support in this area, which is a little bit below our sold strike, but we think it should hit here and bounce. And again, we also, you can look at this chart, generally have sort of an upward bias on the market. That's where we feel it's going. So that's why we picked the trade that we did. Obviously, we're watching it like we do all of our trades to see, and we'll do whatever we think is necessary to try to defend that position or minimize any sort of loss if that seems necessary. But yeah, that's where we're at on it. We're certainly not panicking based on the Russell being down 0.25% today. Yeah. Any more questions that anyone has? We're here until 5. But yeah, if nobody has any more questions, we can also shut it down. Yay, yeah, that one. So let's go. Yeah, we put this out, and then EA announced that they were delaying the release of a video game, and it got pummeled. Is the short version of what happened here. Yeah, so we put it out here. It had pulled back, and we liked its chances to go up from there because we thought the selling was overdone. Of course, new news coming into the picture certainly changes what people think the price should be. EA still has most of the biggest names in video games. The Madden franchise, the Star Wars games. Battlefront is, if I remember correctly, the name of the title that got delayed here. And essentially they delayed it because I think some early looks at the game people didn't like. They didn't like some of the things that were going on. And the gaming community is exceptionally loyal, but also sort of exceptionally picky, if you will. And so, yeah, they essentially pulled the game back in order to try to fix it to goose sales. I personally think this is a little overdone. We've been looking at when to roll this position as well. Considering we started with a $131 call, I don't really like the idea of going too much lower than 121, but we'll keep an eye on it. if we could get some strength in the tech sector, I think we could come back a little bit. But like we looked at earlier, there's a little bit of resistance there that the Nasdaq needs to come through. Rick, I don't actually know if the shooting in Jacksonville had anything to do with the decline. Most of EA's earnings are from actual sales of video games. The tournaments and other things they run are, I don't think, a significant revenue driver at this point. They do, they sort of serve as advertising and community building. And so they sort of build a community around the games, which I think make the games more attractive. But I don't think running those tournaments is actually a significant revenue driver. So it's possible the shooting had something to do with the decline. I don't think the shooting has much to do with the long-term health of the company so much as the delay of a title release did. But yeah, I honestly hadn't really thought about that very much, just because it didn't seem super relevant to me for whatever reason. But that is a good question. It probably may have pushed it down a little bit just because of that tends to be how these things work. Am I optimistic with the EA diagonal? I think the selling is a little overdone. I think it's, yeah, I mean, we could go look at the other video game companies. They haven't sold off this much. Certainly, I don't think the delaying the Battlefield release helps them, but I do think it'll come back, at least to some degree. I don't think there's a reason we should take a $14 loss on it right now. Yeah, I mean, I'm optimistic that we can do better than where it is now. If I wasn't, we'd probably be looking to close it. But yeah, it seems like it's leveled off. If we can stop having, bad things happen, we'll be doing okay there. And I can't imagine they wouldn't have packed those negative news things together if they could. So I think we'll probably be okay there. But yeah, again, right, like it's hard to know exactly what's coming in the future. But I do think we should. I do think this should go back up somewhat as if we can get some strength in the overall market. All right, well, if no one else has any more questions, I'm going to go ahead and close things up here. We'll put the recording and send out the slides as we normally do tomorrow. And yeah, as always, if you have any questions or anything like that, yeah, let us know. So there's 2 questions here. I'm not super sure, Emerson, what you mean by MU status. But if you want to type a little more in the box there, I can give you an update on that. And then I'll take this question from Rick about why does Apple sell off when they introduce new products? Yeah, that's a good question, Rick. It's a thing that has happened for a long time. And so a couple pieces here. Apple gave up ground last week because they said several of their products were on the tariff list. Granted, those tariffs haven't been enacted yet, but they went down a little bit because of that. And then they were up like 2.5% yesterday, and then back down a little bit today. Yeah. It seems like the sort of pattern that high-speed traders should recognize and essentially arbitrage away. If you know something's going to happen, you can trade against it, and then it'll stop happening. But yeah, I don't have a good reason for that. Maybe people are unimpressed. To be quite frank, I mean, the iPhone was revolutionary, and as they iterate into new iPhones, no particular upgrade ever seems like it's going to be a major deal breaker, or a major thing that just changes the world in quite the same way that the original iPhone did. But yeah, they keep selling, so it sells off a little bit when they make an announcement, and then keeps going back up. So yeah, that is a pattern that's sort of well known around the market, but I don't have a good answer for why it happens. And again, right, like if something happens enough times in a row in the market, typically people start trading on it and then it stops happening. And that's why we're not shorting Apple, ahead of every product announcement, because it seems like at some point that should stop happening. But yeah, I don't know. All right, so the MU question is, should I sell at a $14 loss or give it some time to recover on Micron Technology? I mean, it's down towards some, it's down towards some sort of areas where it should have some support. I know Goldman downgraded them this morning. They've slowly been getting downgraded across the street for a while. But I mean, you can see here that commodity cycle I was talking about earlier, right? Like they went up and when they went down, and then they went up and now they're going back down again. So one side of me says that, when the analysts who had kept the buy ratings on the stock the longest throw in the towel and say, all right, it's not a buy anymore, maybe that means you're getting close to a bottom, right? Like that could be a signal of capitulation. The other side says that, if the analyst that somebody follows says it's a sell now, then you're going to bring in more sellers. So yeah, I don't know. I mean, the answer to any question like that is it depends on how long you want to hold it, I guess. Do I think you're going to get that $14 back in the next 3 weeks? I do not. Is it possible if you want to hold it for a couple years that you'll get it back? I think it's very possible. I don't think Micron is actually going anywhere. I just think we're at a point in the commodity cycle where things have peaked and they're rolling over a little bit, and I don't actually know how far down they're going to go before they come back. Yeah. So Rick says, do we have any bear call trades on insurers related to the hurricane? And that's not the kind of thing I like to do. Just because I feel like the time to do it is, and let's see here. If we look at somebody like Travelers, who's big in the PNC game, right? Like the stock's been going down for a week. I feel like the time to short it is probably before the damage estimates start to come out. Because typically those damage estimates come out and then the stock starts to go down. And then from there, in most cases, the damage estimates are pretty close to right or maybe a little overdone, in which case things come back up because things aren't as bad as you thought they were going to be. So I don't, yeah, it's possible you could make money doing that. I feel like the time to do it would have been a week ago. At this point, like, I mean, the other side of that trade is somebody like Home Depot, which is probably up over the same span. Yeah, pulled back a little bit today. Or Generac is a generator company. They're another one. Yeah, again, here you go. It seems like this turn, I don't know exactly what this turn that the storm has made. We're obviously watching it. We're in Charlottesville. So it seems like this turn to the south is going to be good for us. What it actually does in terms of for the dollar value of insured losses, I don't have a good handle on. But yeah, I feel like those trades you need to kind of make a little bit sooner, just because once it becomes an inevitability, it gets priced in. So that's kind of my feeling about that. I feel like that move that we saw in Travelers there, or like something like an Allstate probably had a similar move, right? Yeah. Yeah, pretty much the exact same move at the exact same time. So yeah, it's possible you could make money doing it, but I don't feel. Yeah, I feel like once that first move happens, that's kind of the move, and then after that, it's up to the vagaries of the storm and some things that I don't really feel comfortable betting on. So yeah, that's how I feel about that anyway. All right, with that, it really is time to close up shop here. This has been a great session. We had a lot of questions ahead of time. We had a lot of questions come in during the session. I think this is fun. I like getting questions from you guys and answering them. And I hope this is at least somewhat informative. And useful for all of you who are out there in subscriber land. And with that, I will talk to you in 3 weeks.